All right. You can maximize your view in the GoToMeeting format by looking at the different options on your GoToMeeting screen. You have an option of viewing only the active cameras, so that way you're not looking at a lot of squares of black turned off cameras, and that will help free up some space on your display. There's a chat feature, so please do use the chat feature to raise questions. I will, from time to time, take a look and try to address the questions as we go. So before we get into this topic, normally we start out these roundtables by doing a little update on Strength Matters. Hopefully most of you are members of Strength Matters. Go to strengthmatters.net if you're not a member, and try to join ASAP. There's just a wealth of material there that is of use to the affordable housing community. All of the papers that we've written, all of the webinars that have been put on. There's a listserv for Q&A. There's a community forum where people can pose questions, and just a lot of materials focusing on both accounting and tax issues, all designed for the affordable housing community. So Strength Matters is just a wonderful initiative. What we're trying to do with that is to bring more transparency to financial reporting for affordable housing, in the hope that that will bring more capital, because lenders and donors, grantors, funders will understand our financial statements better if we can do things in a consistent way. And that's why Strength Matters was first created over 10 years ago. During January's meeting, which was our last quarterly roundtable, we kind of missed the quarterly because of the coronavirus thing, but we're trying to get back on track now. I did mention at that time that we are, Strength Matters, finishing up the project of taking the last 10 years of papers that we've written and updating them all for the newer standards that have come out since these papers were written. These have to do with accounting issues related to affordable housing organizations. So we will hope to be publishing the updated final version of all of the papers. There's about over 30 papers on the website. So it's taken almost a year to do this updating, and it's been a committee of several CPAs and CFOs working together. So we're hoping to get that published this summer sometime. Another Strength Matters item is there's usually an annual convening, which has been which was scheduled for New Orleans in the fall. It's now actually going to be a virtual annual meeting instead of having a physical meeting this year. Hopefully next year it'll return to the physical meeting in New Orleans. And the final thing on Strength Matters is the boot camp. So the boot camp, some of you have attended it. It's a 2-day kind of an orientation to accounting issues, as well as some even tax issues in there, mostly accounting, for new manager level people primarily who've entered affordable housing recently. And it's a great way of getting exposed to a lot of the acronyms and accounting concepts and policies and procedures that are typical in an affordable housing project. So the boot camp is something that I've written with a CFO, and we always present it with a CPA and a CFO, both talking for 2 days. And we usually have about 30, 35 people. And we do this, we've done it 3 times a year in California, as well as usually in connection with the NeighborWorks Training Institute in other parts of the country. And lately, Julie Goldfein, who's our co-presenter for this first section today, has been presenting with me on those boot camps. There's Julie waving to us. And what we're doing, though, because of the coronavirus lockdown, is converting the physical boot camp to a virtual boot camp. And so we, Gail Harold and I, Gail is another CFO who was involved in creating it, co-writing it with me years ago. We are now converting the physical boot camp into a virtual boot camp, so that we'll end up hopefully with something that we can present later this year that people can sign up for, a series of 2-hour web-based boot camps modules that, when strung together over a period of many weeks, will produce the same 2-day boot camp that people were used to taking in the past. So watch for that. that'll be coming later this year, we hope. So let's move on to our first topic for today. We are going to be talking about the loan forgiveness for the Paycheck Protection Program, and specifically how it impacts affordable housing developers. The reason we wanted to cover this topic is a lot of our clients, affordable housing developers and managers, have been asking questions about what qualifies and what doesn't qualify for loan forgiveness, and it's kind of a tense issue, fraught with constant changes, because no sooner did I create this presentation a week or so ago, and the next day or two they changed the entire program, so that I had to redo all my slides. And then changes are continuing to happen. As recently as yesterday, a new announcement came out that we'll talk about. But before we get into the details, I do want to introduce my co-presenter, who I mentioned just now, Julie Goldfein with Mutual Housing California. Julie, do you want to do a little self-introduction yourself and also Mutual Housing?
Yeah, good morning. I'm Julie Goldfein. I'm the Chief Financial and Operating Officer for Mutual Housing California. We're a Sacramento-based nonprofit affordable housing developer, property management company, and we also provide services to our communities. We've been around for a little over 30 years, and we have about 1,100 units in our portfolio and are growing. So thanks for having me.
Thank you, Julie. Thank you for all of the work you do, by the way, for Strength Matters. Julie's quite an active participant in the Strength Matters initiative, and like I said, she's been my recent co-presenter on the boot camps. We've done it 2 or 3 times together in the last year or two, and that's been great. Julie and Mutual Housing are a client of ours, so always happy to see you, Julie. Let's move on to our next slide here. So these are the topics that we are going to cover today. There's going to be an overview of the loan application and forgiveness. You know, this SBA Form 3508 is the application to forgive form. What we have is the version that was issued about a month ago, and now that they've changed the law somewhat, this form undoubtedly will have to undergo some changes. We don't have the updated one yet, so we'll show you the original form, and hopefully the new form won't be dramatically different. We'll focus mostly on the steps involved in completing the form, including trying to update that to the extent possible for the new changes that came out last Friday. So there's some guesswork involved in that aspect of it and how that applies to the form. And then most importantly, we will try to focus on those considerations that will be kind of unique to the affordable housing world. So I think it's helpful at first to kind of understand the basic formula that the form is trying to follow. And that is, we start with these eligible payroll costs that are incurred during the covered period. We add what they call non-cash payroll costs in the covered period. And then we add other costs in the covered period, the other costs being mortgage, interest, rent, and utilities. The non-cash payroll costs are things like health insurance on a group plan, retirement, and state and local income taxes. So we add all of these costs together, and then we subtract what they call the salary or hourly wage reduction. So if we have reduced the average wage or salary for any of our employees during the covered period, there's a reduction here that comes into play. And then we also have to use a full-time equivalent reduction if we reduced our headcount. This may or may not be applicable, but if you do reduce your headcount, then there is this FTE reduction quotient, which actually applies to all of the costs above, not just the payroll costs. So once you go through that calculation, the forgiveness amount is the lower of the result of that above formula or the PPP loan itself. And so this next, and there was, before last Friday, this third bullet point said the lower of the payroll costs above divided by 75%. What happened on Friday was when the new law came out, they said that the 75% would be dropped to 60%. However, the wording of it implied that if your payroll costs were less than 60%, there would be no forgiveness whatsoever. So that was a pretty strict change that seemed to be enacted last Friday. Kind of took everyone by surprise. Now, oddly enough, yesterday, a new announcement was made, and I wanted to read it to you here because it calls into question this all or nothing approach on the 60%. So this new announcement came out from the Department of Treasury yesterday, and it says, if a borrower uses less than 60% of the loan amount for payroll costs during the forgiveness covered period, the borrower will continue to be eligible for partial loan forgiveness, subject to at least 60% of the loan forgiveness amount having been used for payroll costs. So the first part of that sentence kind of implies that you can still prorate even if you're below 60%. It's not an all or nothing. So that was seeming clear until the last phrase, which says subject to at least 60% of the loan forgiveness amount having been used for payroll costs. So now that brings back this issue that if you didn't meet the 60% loan forgiveness, then there's no proration. So this is a very vaguely worded announcement, but it did come out yesterday, so I wanted to point that out. This will come back, this topic will come back again and again during the next hour that we talk about this process. So it's a little bit mysterious now whether you have to comply with the 60% or whether you get a partial proration even if you don't comply with 60%. But I'm sure more guidance will come out. So this is how the form actually looks. Oddly enough, it all fits onto one page. As complicated as this calculation is, they've managed to get the form itself down to one page, followed by about 10 pages of instructions. So basically this, we're going to get into all these details, and as I said, the form probably will change because of these some of these new rules. So we're going to talk about this in more detail. So if you can't quite see it, don't worry at this point. Second page of the form are just all of the certifications. Things like all of the covered payroll reconciles to the 941s or appears on the 941s for the organization whose federal ID number was used to apply for the loan. So it's very important to keep track, make sure that we're dealing with one organization, and this is the first issue where affordable housing becomes challenging because you have so many entities. Sometimes payroll is being allocated amongst various entities, and but hopefully the entity that actually is filing the forms 941 and reporting the employee's payroll, that's the one that applied for the PPP loan and will be applying for forgiveness of that loan. But some of the things that'll change on this certification page, the third bullet point, you can see they're talking about does not include non-payroll costs in excess of 25%. So that will change to 40% because the 75% threshold dropped to 60% recently. The thing about does not exceed 8 weeks, that will change. That's the fourth bullet point because now they've extended the covered period from 8 weeks to 24 weeks. So we've got 6 months now instead of 2 months. So there'll be some changes like that, but basically I'm sure there'll still be a form like this of certifications, and the idea is to initial each one of these lines, and then somebody has to sign this form, and that could be a tricky decision because there's one item here that's talking about penalties for inaccurate information on the form, including fines and jail time. So whoever is signing this certification needs to be aware of those potential penalties. So now we can see the actual form itself a little bit blown up. This is just the bigger view of the top part of it. So I think the banks probably will fill out, whoever your lender was will fill out some of this for you, but the FEI and the federal employee number there, you see that's a key item that needs to match the original loan application. And it also needs to match the 941s that you're going to use to support your covered payroll costs. The PPP loan disbursement date is a key date. That's one of the fields there on the form. That's the date that the first proceeds were received. If you had multiple fundings, it's the date that the first one was received. People aren't really sure why they're asking things like employees at the time of the application and employees at the time of the forgiveness. There are other FTE headcount numbers later on that are key, but the value of these two numbers is still kind of unknown. And this EIDL advance amount, that has to do with the economic injury disaster loan. So some of you may have applied for that $10,000 advance, which came with not too much effort. And if so, you're not allowed to use the same cost for both loans. So if you applied for the $10,000 advance or even a higher advance, and you're using that advance for covering payroll, then that payroll, it would not be eligible to be used for this covered period for forgiveness for the PPP loan. And that's a general concept that the federal government has, is anytime one federal source of funds is used to fund something, you're not allowed to claim the same cost from another federal source of funds, because that would be double dipping and getting $2 of reimbursement for $1 of expenditure, which they do not allow. And
Yeah.
Julie, do you want to talk about that issue?
Yeah, we actually applied for the economic injury disaster loan right at the beginning of this, and it might have even been before the PPP loan applications were available. And then our focus shifted to the PPP loans, and we were thankfully funded for that loan. And just about 2 weeks ago, surprisingly, the EIDL advance showed up in our bank account for both of our entities. So we'll just probably be reducing our forgiveness for that amount. Another item I just wanted to touch on is under the Families First Coronavirus Act. We have staff that have taken leave, you can there was an 80-hour bank that was granted to employees for COVID related illnesses or other items for themselves or their dependents, and then the employer will receive a reduction of their federal payroll taxes. So that's another item. If you have staff that are taking that leave, that would need to be backed out of the PPP loan forgiveness.
All right. And another program which used to be creating a conflict here is the one that allows you to defer paying the employer share of the payroll taxes. So previous to last Friday, if you were deferring paying the federal share of payroll taxes, and you could defer paying 50% of it till 2021, and the other 50% you could defer until 2022. So it's quite a long deferral on employer like FICA, Medicare tax. Anyway, if you were deferring that, then you, if you were applying for the PPP loan forgiveness, then you could not participate in the deferral of payroll tax program. But last Friday, the new law said that you can do both. So you can apply for the PPP forgiveness, and you can also defer the payroll taxes until 2021 and 2022. Just the employer share. You still have to deposit the part you've withheld from the employees. All right, so back to this form. Payroll schedule is the next line, and be careful here because, well, under the law, the way it was written up until last Friday, you had a choice of either picking a covered period that started on the day that the PPP proceeds were first received, or the alternative period could be selected if you had either a biweekly or more often pay period. So they have a box you can check for either weekly or biweekly. If you can check either of those two boxes, then you could also elect this alternative covered period, which started on the first day of the first pay period after the PPP loan proceeds were received. So that allowed you to wait until the next pay period, basically, to start this covered period. And it went for the 8 weeks. Now with the new law, they've redefined covered period to be, instead of 8 weeks, now it's 24 weeks. They didn't mention the alternative covered period. Presumably it's still there, but they didn't say it is or is not still there. So that's kind of an open question. But the important thing here is if you're choosing twice a month, which is a semi-monthly pay period, then you're not eligible for the alternative covered period. And of course, monthly or even less frequent, you're not eligible for the alternative period. So the next line is where you identify, are you using the covered period, and if you're going to use an alternative covered period, you would indicate what that is. Now it's up to 24 weeks at your option. You can still use the 8 weeks, but if you need more time to spend the money in the allowable way, you have up to 24 weeks, but no later than December 31st, 2020. And that alternative covered period was only for the payroll costs. It didn't, you couldn't use it for the non-payroll type costs. So the very last line you see there is this $2 million question, and that is simply, I think mainly it's there because if you borrowed more than $2 million, probably more likely that your loan is going to be audited ultimately. Also, if you were under $2 million, there was this good faith process where you didn't have to justify that you needed the funds because of the coronavirus. They just assumed if you're under $2 million in loan funding, they were assuming that everybody had enough business disruption to need that funding. So if you were in excess of 2 million, and you're supposed to include all of the affiliates. So Julie, I think you had a couple of organizations that applied. So you would need to add all the loans from all the commonly controlled organizations, same board control, and check the box if that's more than $2 million.
Yeah, we applied for both of our companies, our development and management company, which it was less than $2 million. So hopefully we're not subject to an audit.
Yeah, well, they didn't say that they weren't going to audit anyone under $2 million. It's just that, they have a limited amount of resources, and maybe they'd be best served by only auditing the ones over 2 million, but they never said that. But they did say that if it was under 2 million, they would, as far as eligibility for the loan itself, they would take your word for it that you needed it. It was a good faith representation that you needed it, and they believed that you needed it for the loan. But forgiveness is a different question, and they may still come back and audit those. Depends on probably how much time and resources they have for auditing. This is the bottom portion of the 3508 form, and here you can see the basic formula I described before. Payroll costs, there's a schedule where that's all detailed out, the mortgage interest payments, the business rent or lease, utilities, and then we get into these reductions, FTE reductions. We're going to work through this, and so you'll see how it all works. There's a salary reduction as well as a FTE reduction quotient. And then there's a part at the bottom where they're comparing the modified total, which is the result of all of these figures. Compare that to the PPP loan amount. The old version of the form had this 75%. The new version will probably either change that to 60% if the proration that they announced yesterday holds, or it'll be more of a cliff thing where if you didn't meet, if line 1 was not 60% of the total, then there's no forgiveness, which is the way people were interpreting the law that was passed last Friday up until yesterday's announcement. So that remains to be seen. But anyway, line 10 will be changed one way or the other. And then line 11 is where they calculate the lower of all of these other calculations.
And with regard to the business mortgage, we've been viewing that, I guess, as corporate debt, either on a building or maybe warehouse, building where you house your employees, or a warehouse where you used to store facilities, if that applies. And the rent also is, we're interpreting that as being for our corporate entity.
And another little confusing thing is they use the term paid or incurred, but we think probably when they say paid or incurred, they don't really mean what that literally means. They probably only going to be if it's incurred during the covered period and paid by the next billing cycle after the covered period. There's a big chance that with the higher 24 weeks of covered payroll costs period, it may give you more time to accumulate enough payroll costs where you don't even have to get into the mortgage interest and the rent and the utilities to decide whether or not it's been paid and incurred, or paid or incurred, or only paid, because anyway, those definitions are still a little bit vague. The payroll part of it's a little bit more secure. So the longer you pick out of this 24 weeks, and it's your option how long you want to go there to incur enough payroll costs to qualify for forgiveness, then you don't have to get into all of these other types of costs.
I think we're thankful that they extended the period, because at 8 weeks, it was looking like maybe 85% of our loan would be forgiven.
Oh. So you would be leaving 15% on the table for all of these costs. But under the new 24 weeks, now you'll hopefully get 100% forgiveness. And that was the intention of the change. So looking at Schedule A, this is where we're trying to summarize most of the payroll cost, and we'll get into more details on this one. The top 5 lines of that Schedule A look like this. So they have, we're separating out our payroll into 2 categories. There are the people that made less than $100,000 in 2019, and then the people that made more than $100,000 in 2019. And the first category includes new hires in 2020. So that first category goes on what they're calling Table 1, and the second category, the highly compensated ones, go on Table 2. So there's a worksheet we'll look at where we calculate the Table 1 numbers. We do the average full-time equivalent calculation. We'll see how that works. We do this salary hourly wage reduction. We'll see how that works. But basically, if the average annual salary for each employee, and this is fairly laborious calculation because one person at a time, if the average annual salary or hourly wage for each employee in Table 1 was at least 75% of what their annual salary was during Q1 of 2020, then you don't have to do any salary hourly wage reduction. So that may not apply if you didn't decrease anybody's salaries or wages. That particular reduction doesn't apply to the highly compensated. So for lines 4 and 5, it's just the compensation totals and the average FTEs. Then here's where we get into the next few lines, the other, what they're calling non-cash compensation payroll, health insurance under a group plan, retirement benefits, state and local payroll taxes on compensation.
And for us, kind of going back on the employee retirement plans, I know some employers fund the employer match maybe once annually. For us, we're funding it, the employer matching contribution, every pay period. So we'll be able to take advantage of that under the kind of paid and accrued language that the SBA is getting out.
Okay. Compensation to owners, which was not actually to be included in either of the preceding calculations, comes in next. We probably don't have that situation in our affordable housing, most of them being nonprofits with no owners. But if there were owners, then you would put their compensation here. And that you come down to the total payroll costs. The FTE reduction calculation, this is involving a calculation of the number of FTEs during your chosen reference period and comparing that to the number of FTEs during the covered period. So there's a reference period calculation. You've got a couple of choices for what your reference period is, but then there's also the covered period calculation, and you're trying to determine that there hasn't been any reduction in the number of FTEs. For some reason, my PowerPoint went back to the beginning here. Catch up with it.
And so, yeah, for us, we're trying to determine which reference period works better. I think, thankfully, we actually had some new positions that we had added this year, which we did not have last year. And so I think that's helping us with meeting that requirement so that we won't have hopefully minimal, if any, reduction as related to this, the two periods of time that you need to compare. We did have one employee, unfortunately, that we furloughed during this process, so we're trying to figure out how that comes into play.
So these reference periods I was describing, you have a choice of either using the period from February 15th, 2019 through June 30, 2019 for your average FTE headcount, or you can use January 1st to February 29th, 2020. You can pick either one of those. If you're seasonal, you can also pick any 12-week period between May of 2019 and September of 2019. So you got a lot of choices for the reference period. And like Julie said, the important thing is to pick the one that will produce the least amount of FTE reduction in headcount when you compare it to your covered period. FTEs, by the way, are based on the 40-hour week calculation. And the good news is, back on that one, if you've restored the headcount by, well, under the old rule, it was June 30th. Now you have until December 31st to restore your headcount. The problem is you have to wait until the date you selected to apply for the forgiveness. And so if you wanted to do this after your 8 weeks were over, then you have till June 30th to restore your headcount so that you didn't have to go through the FTE reduction quotient. The Schedule A I talked about earlier, this is how that looks. We had the Table 1 for under 100,000, Table 2 for over 100,000. Hopefully your payroll provider will help with this, at least giving you the names, the cash compensation part of it, and maybe they can also disregard any people on the payroll that have more than 100,000 so that you're only reporting the compensation for up to 100,000 annually.
Yeah, and we just received notification from our payroll provider yesterday, Paylocity, that they have a kit of different reports in their software that will help us with this process. We were with a different company last year and they had a great report, so I'm hoping that we'll get similar type of reporting to help us with the loan forgiveness calculations.
Great, so that's a closer view of that first table. And so I think, this is probably a good time to finally get to this one issue that's, I think, on everybody's mind, and that is, and I think it's even come up in the chat questions, the cash compensation really is the compensation, the way it's been defined, is the compensation that appears on the 941 for whichever company is applying had applied for the PPP loan. So the federal ID number is already identified. So you know which employees are on that company's payroll, and you're going to be submitting the 941s for that company along with this documentation to support the amount you're asking for forgiveness. So you have to be consistent in which company's compensation you're dealing with here. And one of the issues that comes up in affordable housing is often there's a management company that is funding payroll, but then it's allocating payroll to other affiliated organizations. And so that creates a risk, because back what I was saying earlier about the double dipping problem, if the first of all, if the compensation doesn't even appear on the organization's payroll, then it may not be subject to forgiveness, because it's not a compensation item that was incurred by the organization who applied for the loan. My battery is running low, so I'm going to plug myself in here. Hold on. Julie, do you want to talk about that issue? Maybe it's a good time for the group question.
Yeah. So, you know, we're still viewing it from the perspective that there's still an economic cost to having our properties operating. So right now, what we've been doing is our management company does employ the staff, pay all the payroll, and we're still charging our properties for that payroll to kind of keep our economic costs consistent. But then we're not recouping the dollars until the confirmation that the loan will be forgiven. That was something that came up when we applied for the loan with our lender. And they said, you know, you're looking for a really large loan, but we don't see that that's, you know, same amount of payroll on your management company's books. And so we were able to provide reporting to them that showed the payroll across our management company and the properties in our portfolio. But I'd be curious, as this has been a huge topic that has come up in a lot of the other classes that I've been taking, as if anybody else wants to share what they've been doing or what's been working for their group. And Scott, are you able to unmute everybody?
Yeah, let me do that now.
See how this works.
Okay, I've unmuted everyone.
So does anyone want to share the approach that they're taking with their company's payroll?
Now, I think probably before you can speak, you have to unmute yourself as well. So on your GoToMeeting, there's a microphone image. You have to click on that to unmute yourself.
So I will share. It's Mary Stomp with PEP Housing. So we've been working on this issue, and everything does run through our management company, but then we bill out to the individual, you know, inks and partnerships. And we were told that specifically rental housing was excluded in the PPP, so that we could not recoup salary and payroll taxes and benefits for any of the inks or any third party management contracts that we have. We can only get reimbursed for actual salaries that are being charged in the management company, not those charged out.
And that response actually coincides with what I was thinking, which is once you allocate the payroll costs away from the management company to other affiliates, I think you are running the risk that now these costs no longer will appear necessarily on the financial statement of the management company. And so given that this whole forgiveness application is subject to audit, and one of the things auditors might look at is the financial statements to see how you reported that payroll. So it may not be enough to show that it's on the 941. It may come to pass that if it's not on your financial statements because you've allocated it to some other entity, then they'll think, well, why should you get forgiveness for something that ultimately you didn't incur because you made a journal entry to get rid of those costs and pushed them to someone else. So it's kind of like the double dipping law. So because the reason it's vague is because of course the instructions don't envision that there's going to be payroll allocations to other companies, so we don't have any guidance about it. So everyone's just trying to interpret it, but that's the way I would interpret it.
How would you handle though, say you have a, if we are the limited and general partner of a partnership, and the partnership has to stay in existence because of a loan that's on the property, and so we're getting all the residual receipts and all of that. Could you make a case to keep those wages in the management company because they're being and then get reimbursement for those, since they're going to flow to the management company anyway?
Yeah, so that is another gray issue. So, if we say that we should keep the wages on the books of the management company so that we can be eligible for forgiveness, now if you have charged another entity, so now we're saying instead of the last scenario where we got rid of the expense altogether with a journal entry and allocation, now we're saying we're going to leave the expenses on the management company, but we're going to charge another company for those expenses. So we did get reimbursed. I think that's risky too, because now, again, the auditor can see, well, you got reimbursed for that from a third party, namely that partnership you just described. And why should the federal government reimburse you for costs that you already got reimbursed for from somebody else? Again, the law doesn't say this. The law only speaks to federal reimbursements as being ineligible. But it seems logical that any kind of reimbursement from anybody would be ineligible because it's all double dipping either way, any way you look at it. So I just think it's risky. But we don't have any guidance, so there's no official answer.
When you say that it's from a third party, but if it's all related, and I think the question was if you're the general and the limited, right? So that there is no third party. Is that really a third party if the partnership is wholly controlled by the entity?
Yeah, so it gets into the issue of who applied for the loan, and they seem to be in the instructions and in the law pretty specific that we're talking about the federal ID number of the applying organization, and so that's just the management company, and so the reimbursement is coming from a different organization with a different federal ID number. So you may be right; they may be willing to say that's okay to get paid twice for the same dollar, once from the federal government and once from the affiliate. But my fear is that they wouldn't be that generous, and I think it might be risky.
And I think from our perspective, we were only planning on getting the loan forgiveness, but not actually collecting the cash back from the properties. So we would only get paid once on those dollars, but still continue to allocate them. Now, whether or not our CPA firm has a different opinion, we'll see at the end of the year.
Yeah, I think that is a conservative way to do it, and a step further is so following up on Julie's suggestion, what some organizations have said they will do is forgive the normally you set up an allocation of payroll to the affiliate, and that creates some type of receivable. Well, instead of collecting on that receivable from the affiliate, you would ultimately forgive that once the loan was forgiven. And so that would be one approach. My fear with that, I'm a fairly risk-averse person, so my fear with that approach is that even making the journal entry to accrue the repayment of that payroll from the affiliate is prone to some risk that you're creating some type of reimbursement structure, even though ultimately you forgave it later on. So my suggestion to be super careful is to not even charge the payroll to the affiliates if you're going to be asking for reimbursement from the PPP program. And so the management company would just continue to show payroll for all those payroll expenses that are ultimately going to be reimbursed by the federal government, and they wouldn't even allocate them to the properties. And the reality is, if you, one of the problems is the IRS has said that once you fund payroll costs or any costs with PPP loan money, those costs are no longer deductible. And so I think the problem is that it's probably a good idea to keep those costs in the nonprofit organization management company, because it doesn't matter, you're not taxable anyway. But if you push the costs into a partnership, taxable partnership, then maybe those costs are not going to be deductible if they were reimbursed.
I had a related question about we're receiving a grant from a private non-federal party to cover payroll for a particular position. Would that also, it would take a lot of digging for the federal government to figure that out, but that also could be construed as double dipping.
Yeah.
And to be conservative, we should exclude that from the calculation.
I would, to be safe. The beauty of the new law is you got till 24 weeks, December, to come up with qualifying costs. So there's no need to load this up with questionable costs if you can avoid that risk. All right, let's move on. We're getting to the end of our first hour, and we need to keep the show moving along here. Hold on. All right, so this is the worksheet we were just talking about. I think we've covered that pretty well already. Let's go up a few slides. Safe harbor I talked about briefly, where we were comparing the FTE headcounts. So I think let's just move in the few minutes that remains in our hour. Let's talk about kind of a case study where instead of the forms, the way they're laid out in the instructions, I think it makes more sense to kind of build up to the form by creating this type of doing it in this order. So table 1 is probably where you would start with your covered compensation, your average head counts, and your salary reduction. All of that shows up on this table, and then the results. Those are the people under 100,000. The results then go forward onto a different schedule, but we would start here, and this is hopefully what our payroll provider would provide. When it comes to the average weekly FTE calculation, you got a couple of choices. As I said, 40 hours is 1 FTE, but people who are working more than 40 hours are still 1 FTE, and then those working less than 40 hours, you can either divide the actual by 40. So you see employee 3 working 35-hour weeks qualifies as a 0.9. So you can go down person by person, and that would give you, in this case, 4.7 FTEs. But you could also do a simplified alternative method where everyone who's not full-time is 0.5. And then that's just a faster way. In this case, that only gave you 4.5. So you're better off, if you can, to use the actual allocation in this fact pattern. But anyway, you can choose either of these two methods.
And we only have a couple part-time employees, so we're looking to do it both ways to see what's going to be most beneficial.
Yeah, that's the smart way to do it. Do it both ways and then pick the one that's the most helpful. The second table, this is the people over 100,000, still doing the FTE calculation, no longer have the payroll reduction calculation to worry about for these highly compensated people. That 15,385 number, that was the limit, because someone who made 100,000 a year for the 8-week covered period, they would only be, when you prorate 100,000 over 8 weeks, you get 15,385. So that was the limit under the old rules. Now that we've got 24-week period, that number becomes a much higher number. It's 46,000 something. 46,154 is the new limit for a $100,000 person for 24 weeks. This is just a sample of how you might create this form. Wanted to show you, this is actually thank you to a firm, a member firm in our association, BKR International. The member firm Anshin Block and Anshin is a New York City-based firm, and they created this schedule, which I think is a helpful way to understand how to look at each employee to see if you met the safe harbor. So just to see how this works, employee number one during your covered period was earning an annualized salary of $60,000. However, during Q1 of 2020, they were earning $80,000. So there's a 75% ratio there, but that met the safe harbor. So there is no salary hourly wage reduction for them because they met that 75% threshold. But employee three wasn't so lucky because their wages went from a $90,000 annualized down to $65,000 during the covered period. So they just fell under the 75% threshold, so didn't meet the safe harbor. So then you have to go on and do a second calculation where you're comparing their February 15th wages to the wages during the covered period, and looking then at this second look back date, which is the June 30th. Now it's going to be as late as December 30th. See if you restored it. And in this case, what it shows is that 75% of the $90,000 they were making before is $67,500. What they were actually paid was $65,000. So there was a $2,500 reduction. And because that's more than this, because they didn't meet the 75%, you now have to kind of create what is an 8-week or covered period portion of that annual $2,500 reduction, and it works out to be $385. If you're doing 24 weeks, that would be a bigger number, but the total numbers would be bigger as well. And employee 5 is just another illustration using an hourly approach, but it's the same idea. And then you multiply that times 40 hours a week, and then times 8 weeks or 24 weeks to come up with the salary reduction. So that's where those numbers came from we were seeing earlier. The FTE safe harbor, this is showing two different situations. One is where the total average FTEs between February and April, which was the same covered period we saw before, was 5, whereas the number of employees on February 15th was 7. So we failed the FTE reduction safe harbor. But in the scenario 2, in both cases, we're looking at the June 30th, or now it would be December, up to December 31st. And so because they had only restored up to 6 employees, whereas there were 7 before, they didn't meet the safe harbor. Whereas in scenario 2, they did restore back to the level of 7, which met the February 15th. They met that safe harbor. So then you don't have to worry about the FTE reduction. So now we finally get to summarize all of this payroll, non-payroll numbers, and comes down to this $138,000 number in this sample. The FTE reduction in our sample was based on 85% quotient, which is the ratio of 4.7 to 5.5. And we finally get to calculate the forgiveness. So we add up the payroll costs from that previous schedule plus the mortgage interest, the rent, utilities, subtract that payroll salary reduction number, which were the 2 numbers in blue from the earlier slide, comes down to a net number, multiply that times the 85% FTE reduction quotient, and we get to $163,000. And we compare that to our PPP loan of $185, and we pick the lower of the 2, which was the $163. The form used to have on line 10 there, it was the 75%, where if the line 1 was less than 75% of the total costs, then you would prorate, and you would pick the smaller of lines 8, 9, or 10 in order to complete line 11, which is the actual forgiveness. Now, as of last Friday, it looked like it was either all or nothing. If you didn't meet the 60%, then nothing would be forgiven. As of yesterday's announcement, which I read earlier, there's still some vagueness about what is their intention with that. So it may be that you can prorate the forgiveness just like before, based on the 60% instead of 75%. So getting towards the end here, the documentation to be submitted, the forms, of course, the schedules, the bank statements, third-party payroll, provider reports, tax forms, 941s, state equivalents. For those other types of costs, you'd want payment receipts, canceled checks, statements, things of that nature. Also, documentation showing how these FTE counts were created, either the 941s or state equivalent, or even unemployment insurance filings, something that identifies the number of employees during each of the periods that you're using for your head counts. For the other types of expenses, we talked about the business mortgage, the business rent, and utilities, copies of bills during the covered period, as well as the next bill after the covered period to show the payment that was made during the covered period. And they want you to retain all of this for 6 years after the date of forgiveness. So that's apparently how long they might get around to auditing it. So here's some of the takeaways, I think, some of the things to maybe questions or how it might really affect the affordable housing community. One is back on this topic of the FEIN on the application, make sure it agrees with the 941s that are claiming the covered payroll, and all of these numbers are based on that entity only. And then the issue about if any of these costs are covered by other grants, definitely federal money, that's not allowed. But also it could extend to other reimbursements from non-federal sources. That's vague. We don't have a definitive answer yet about that, but that seems logical. So if the costs are reimbursed by affiliates, they could be considered ineligible. So maybe consider not even charging the affiliates for those costs that are going to be funded by the PPP loan. You know, if the loan forgiveness doesn't occur, you can always go back and make journal entries and bill them for those things, but it might be safer not to allocate those costs during your covered period for now. And there was a question about management fees, kind of similar to somebody else's question. One of the viewers asked about the grant they were getting from a non-federal source. And if the management fee is basically to pay the payroll of the management company's staff, should you forbear charging management fees during your covered period as well? That's an open question. And you know, if the expense is not appearing on the financial statement, I think this is a key for whichever borrower's FEIN is used on this application. If the expense is not showing up on that borrower's financial statement, it may not qualify for forgiveness. The way they're describing the backup documentation to retain includes financial statements. The auditors may be looking at financial statements just to see if there were other sources funding these same dollars. Consider putting the PP funds in a designated bank account. I think, Julie, you're doing this?
Yeah, we do have a separate bank account now. While I'm not calculating the granulated amount of what we think will be forgiven each pay period, but we're just funding the payroll transfers from that bank account to cover our payroll. And then we'll be doing kind of the detailed calculations of the loan forgiveness on the back end. And Scott, there are some questions in the chat. I don't know if we have time to address those, or
let's take a look at those. Okay, the most recent question was, will the calculation samples be made available? Yeah, so if you are interested in getting a copy of this slide deck, please email me and I will send it to you. Also, if you want CPE credit for this presentation, if you're a CPA and you need this 2 hours of CPE, send me a chat right now with your name so that I know that you're going to be wanting to claim CPE. So this will be one of those attendance tests that we have to do for CPE purposes. And I'll do it again. I'll ask again at the end of the 2 hours to give you the CPE credit. So please send me a chat now if you want CPE credit, and then I'll ask again later on. And if you want a copy of the slides, let me know that too in the chat request, or just send me an email later on. Let's see now, what other questions were in the chat?
There was one from Warren about double dipping. Scott keeps speaking of double dipping. If your primary source of revenues are government contracts and grants where payroll costs are reimbursed to our not-for-profit, can you confirm those monies will not qualify for loan forgiveness?
I think so. I mean, that seems to be the interpretation. If the payroll costs are funded by, certainly by any federal dollars, it seems like those would be ineligible for forgiveness. The question is, non-federal reimbursements, would that also apply? And my point has been that to be conservative, I think it might. There's not any guidance that tells you one way or the other the answer to that question. So I think it's important to involve your board of directors. And I think that might be on this slide too, if takeaways. Some of these are kind of gray areas, and I think it's important to get the board involved in some of these difficult decisions. You don't have to shoulder a lot of judgment issues all by yourself. You can run some of these things past your board.
Do we have time for another one?
Yeah.
Karen asked, since there's now an extension of the forgiveness period, we could keep all the payroll costs in the parent organization. Would there be a problem with doing that since we included the subsidiaries in our calculation for the loan?
Well, I don't think that should be a problem, because if the parent's federal ID number was the one on the loan, even if there are others involved in the calculation, I think ultimately what it comes down to is which federal ID number did you use on the loan? And if that was the parent, I think it would probably be a little bit safer to keep all those payroll costs in the parent, just to be consistent. That's kind of been my moral all morning in this presentation, is be consistent between the original loan, the forgiveness application, the 941s, the financial statements. Make sure the costs are always hitting the same one company, not spreading out to a bunch of other companies. Julie, are there any other chats that we should?
The last one was from Karen, or this was actually right. The first one was, there clear guidance at the time of the PPP application that set out the FTE calculation?
I don't think they were too clear about a lot of things when the original PPP loan applications were being completed, because I believe the SBA had some pre-existing FTE guidance, which I don't necessarily think is consistent with what they're doing now on the PPP program, the 40 hours a week, for example.
And there are some more. Are we out of time, or?
Maybe we could do one more.
All right. So this is from Michael. Can we choose a period that is in between 8 weeks or 24 weeks, or is it one or the other? If I have enough payroll costs after 6 weeks, maybe up to the bank we use. So I think they're trying to figure out if there's a middle ground between those two periods.
Yeah, I think there is. The way I've read it, this new law just came out on Friday, so it hasn't been a lot of time to absorb what it said, but it's been 4 days now. Yeah, it seems to be saying no later than December 31st, and I think no more than 24 weeks. So I think you can choose anything between the 8 weeks. You can even stick with the 8 weeks, or anything up to 24 weeks, anywhere in between might work as well. This process, I should mention, is going to take some time, because once you submit the application to the lender, they have 2 months to review and either approve or deny your application for forgiveness. Once they make their decision, they submit it to SBA. SBA has 3 months to either accept or deny the forgiveness. And then if they choose to deny it, you have 1 month to appeal the decision. So 2 plus 3 plus 1 is 6 months from the time you submit the application until it could be the final decision. So this could go on for a while, this whole process. So if you already have enough payroll costs, risk-free payroll costs to qualify for 100% forgiveness, seems like you'd want to start that process sooner rather than later. Okay, I think it's probably a good time now to turn the presentation over to Stan Wu, who is going to be switching gears, talking still about provisions of the CARES Act, but more about the tax aspects of that. Let's see if I'm able to make Stan the presenter now. All right, here we go, Stan. I think it's
okay. Let me get set up here.
Well, Stan, we don't see your camera yet.
Do you see my screen?
I do.
Okay. Oops. Okay, how's that?
Looks good.
Okay, today we're going to talk about the tax relief for affordable housing that is provided for in the CARES Act. The CARES Act made changes to the business interest limitation rules under Section 163J of the Internal Revenue Code. The CARES Act is increasing the deduction limitation and thereby giving taxpayers the ability to deduct more interest expense. Under the CARES Act, the interest limitation will be based on 50% of the adjusted taxable income instead of the 30% of adjusted taxable income. We'll get into the computation a little later. The CARES Act tax relief is only temporary. That is, the higher interest limitation is only for tax years 2019 and 2020. And if the entity is a partnership, the higher interest limitation is only for the tax year 2020. So before I get into the computation, I want to give you a little background on Section 163J. Starting in 2018, for certain taxpayers, the deduction of business interests became limited. not all taxpayers were subject to this interest limitation. There's an exception for small businesses. A business is considered to be a small business if its average gross receipts for the prior 3 years is $25 million or less. However, entities that are tax shelters cannot qualify for the small business exception. And a tax shelter includes a partnership in which more than 35% of the partnership losses are allocated to limited partners. So almost all low-income housing tax credit partnerships are considered to be a tax shelter because these LIHTC partnerships, they do generate losses, and usually more than 35% of the partnership losses are allocated to limited partners. So therefore, these LIHTC partnerships are tax shelters, and therefore they cannot qualify for the small business exception and are therefore subject to the business interest limitation rules under 163J. To avoid this interest limitation, the LIHTC partnership can make an election to be an electing real property trade or business, which we will discuss a little later. So let's get into the computation of the interest limitation amount. Prior to the CARES Act, for the LIHTC partnerships that are subject to the interest limitation, the interest deduction cannot exceed the sum of business interest income for the tax year plus 30% of the adjusted taxable income. And we'll refer adjusted taxable income, we're going to call it ATI going forward. So this limitation, we'll also call this the cap amount. The CARES Act has changed the 30% of ATI to 50% of ATI. Therefore, the CARES Act provides a larger cap amount. So let's move on to define what's adjusted taxable income. So adjusted taxable income is the taxable income with certain adjustments. The adjustments are interest income, interest expense, and depreciation and amortization. So therefore, ATI is taxable income computed without regards to these adjustments. So let's look at an example. So here we have a partnership with gross rents of $800,000. And the partnership has a net loss of $550,000 from operations and interest income of $3,000 for the year 2020. The total interest expense before the limitation for the tax year was $300,000, and the total depreciation and amortization expense was $500,000. So basically, taxable income or loss before the interest limitation is a loss of $547,000. And this includes $550,000 loss from operations and $3,000 of interest income. So that nets to a $547,000 loss in loss to go from income loss before the interest limitation to the adjusted taxable income, certain disregarded items are either added back or subtracted. So in this case, $3,000 of interest income is subtracted, and $300,000 interest expenses added back, and $500,000 of depreciation and amortization is added back. So the adjusted taxable income in this case is $250,000. The interest cap amount is equal to a certain percentage of the ATI plus interest income. So here we have the computation for under the pre-CARES Act and then under the CARES Act. So adjusted taxable income was $250,000. Under the pre-CARES Act, we can only use the 30% of ATI. And then under the CARES Act, we would be using 50% of ATI. So the percentage of the ATI then is added to the interest income amount. And as you can see from the example, the interest cap amount under the CARES Act is higher than the limitation amount before the CARES Act. So we're looking at the $128,000 cap amount versus the $78,000 cap amount. Interest expense in excess of the cap amount is disallowed in the current year, and the excess interest expense will be carried over to the next year. And the general rule for carryover is the excess interest expense is treated as business interest paid in the following year. The carryover rule, however, for partnerships is slightly different. For partnerships, the excess interest expense is not carried over at the partnership level. The excess interest expense is allocated to the partners of the partnership and will be carried over at the partners level. A partner will not be able to deduct the excess interest expense until the partner receives an allocation of excess taxable income and excess interest income from the same partnership in some future year. As mentioned earlier, the 50% ATI is not applicable for partnerships in the tax year 2019. It is applicable only for tax year 2020. However, some relief is provided to partners of the partnership for the 2019 excess interest expense. Under the CARES Act, 1/2 of the 2019 excess interest expense can be deducted by the partner on its 2020 tax return. The deduction is permitted even though the partner does not receive an allocation of excess taxable income or excess interest income from the partnership in 2020. The partner's remaining 1/2 of the excess interest expense will continue to be carried forward by the partner. Without provisions in the CARES Act, the entire excess interest expense would have been carried forward by the partner and it would not have been deductible by the partner until the partner receives an allocation of excess taxable income or excess interest income from the partnership. Although the provisions in the CARES Act allow for increases in business interest deduction, taxpayers can elect out. There is an option to elect out of using the 50% ATI amount for computing the cap amount. In addition, a partner that's allocated the excess interest expense can elect to not deduct 1/2 of the excess interest expense on its 2020 tax return. Electing out would mean that the taxpayer would be getting a smaller deduction for interest expense. It would be rare to see a taxpayer electing out, but there could be situations where it might be desirable. For example, a taxpayer may have net operating losses that are expiring, or certain credits that may be expiring. In which case, they would want a smaller deduction so that they can utilize these expiring net operating losses and expiring credits. Another provision in the CARES Act that may help in increasing business interest expense limitation is the election to use the 2019 ATI amount instead of the 2020 ATI amount in computing the interest cap amount for tax year 2020. Because of the economic downturn in 2020, it is likely that the 2020 adjusted taxable income would be lower than the 2019 ATI. And if so, the interest cap amount would be quite small for the tax year 2020. To provide the relief, the CARES Act added a provision to the Section 163J to allow a taxpayer to use its 2019 ATI in computing the interest cap amount for the 2020 tax return. A business involved in real property can avoid the Section 163J interest limitation by making an election to be treated as an electing real property trade or business. We refer to this election as the rip-top election. As you will see in a moment, there could be a price to pay for making the rip-top election. Election, the taxpayer is not would not be subject to an interest cap amount. Once the rip-top election is made, the election is irrevocable. The trade-off in making the rip-top election is that the residential real property that is used in the taxpayer's business is required to be depreciated over the longer ADS life instead of the maker's life of 27.5 years. The ADS life is either 30 years or 40 years, depending on when the property had been placed in service. The residential real property ADS life is 40 years for pre-2018 property and 30 years for property placed in service in 2018 or after. The decision to make or not make the rip-top election could be based on maximizing the deductions. Making the rip-top election may increase the amount of interest deduction, but it may reduce the amount of depreciation. Not making the rip-top election may increase the amount of depreciation, but reduce the amount of the interest deduction. The rule for making the rip-top election is it has to be made timely, and once made, the rip-top election is irrevocable. However, in light of the CARES Act changes made to Section 163J and other tax law changes not discussed here, the Internal Revenue Service has recently provided a chance for taxpayers to rethink their decision on whether or not to make the rip-top election. The IRS issued the Revenue Procedure 2020-22. The Revenue Procedure 2020-22 was issued in April 2020 after the enactment of the CARES Act. And this revenue procedure provides an opportunity for tax years 2018, 2019, or 2020 for the taxpayers to make a late rip-top election or to withdraw a prior rip-top election. And please note that the opportunity to make a late election or to withdraw a prior election is available only for those 3 years that I mentioned, 2018, 2019, or 2020. And after 2020, it goes back to the old rule. The election must be made on a timely filed return. And once the election is made, the election is irrevocable. A withdrawal of a prior rip-top election will be treated as if the election was never made, and the late election or a withdrawal of a prior election has to be made by a certain date. It has to be made on an amended return filed by October 15, 2021. Late election or withdrawal of the election by the partnership that are subject to the centralized partnership audit regime must be made on amended return before September 30, 2020, or made on a administrative adjustment request by October 15th, 2021. So even though there's opportunities for taxpayers to be making a late election or a withdrawal of an election, it has to be made within a certain time frame. So this brings us to the next topic on amended returns for partnerships that are subject to the centralized partnership audit regime. The Bipartisan Budget Act is what brought the centralized partnership audit regime into play. The CARES Act provided retroactive tax relief that affects partnerships, and retroactive tax relief is obtained by filing amended returns. The Bipartisan Budget Act of 2015 enacted the centralized partnership audit regime that eliminated the ability for some partnerships to file amended tax returns beginning in 2018 and thereafter. The partnerships impacted are known as the BBA partnerships. Without the option to file amended returns, the BBA partnerships would be unable to take advantage of the CARES Act relief except by filing an administrative adjustment request. We refer to these as AAR. However, the filing of an AAR delays the relief provided by the CARES Act because adjustments reported on an AAR are not reported by the partners on their return until the year the AAR is filed by the partnership. For example, an adjustment related to the 2018 return, say there's an adjustment to a tax credit reported by a BPA partnership on an AAR in a subsequent year, say in 2020, would be reported by the partner of the partnership in the year the AAR is filed. So in this situation, a 2018 credit is deferred to the 2020 tax year. If the partnership had been able to file an amended return instead of the AAR, the 2018 credit would have been reported by the partner on its 2018 tax return. BPA partnership is a partnership that did not or could not elect out of the centralized partnership audit regime. Only certain partnerships can elect out of the CPAR, and in order to qualify to elect out of CPAR, a partnership have to have 100 or fewer partners, and each partner is either an individual, a corporation, an S corporation, or an estate of a deceased partner. So ineligible partners would include partnerships, trusts, disregarded entities, and nominees. Most of the low-income housing tax credit partnerships that we see would be BPA partnerships. Generally, at least one of the partners in the LIHTC partnership is a disregarded entity or a partnership. The IRS provided some relief to partnerships for filing amended returns. The IRS issued the Revenue Procedure 2020-23 on April 8th, 2020. This revenue procedure offers temporary relief and is only applicable for the 2018 and 2019 tax years. And it's applicable if these, in these years, if the original returns were filed before the issuance date of the revenue procedure. Note that there's a time limit for filing the amended return. The amended return needs to be filed before September 30, 2020. The LIHTC partnerships will be impacted severely by the centralized partnership audit regime, as indicated in my earlier example. Tax credits earned in 1 year may not be claimed by a partner until a few years later because of the inability of the partnership to file amended returns. This is the exact situation that the LIHTC partnerships are now facing under the current IRS guidance for claiming the low-income housing tax credit. A partnership cannot claim the credit on its return until the Form 8609 has been issued by the state credit agency in California, that's TCAC. Oftentimes, there are delays in the process, and the 8609 isn't received by the taxpayer until after the filing due date of the partnership tax return. And therefore, the low-income housing tax credit isn't claimed on the original filed return. In the past, prior to the centralized partnership audit rules, the credit would be claimed on an amended return. And then once the centralized partnership audit rules became effective, the credit claimed by the partnership, that is a BBA partnership, would be claimed on a AAR. And as noted earlier, credits claimed on a AAR is reported by the partner in the tax year in which the AAR is filed. So deferral of the credit can result in this situation, and the deferral of the credit is going to result also in a downward equity adjustment. Affordable Housing Tax Credit Coalition is a trade organization based in Washington, D.C. It's a trade organization of housing professionals. And this organization had contacted the IRS in late February of this year to seek a change in the IRS guidelines for when LIHTC, when the low-income housing tax credit can be claimed on the tax return. In its letter to the IRS, the Affordable Housing Tax Credit Coalition proposed that the IRS modify the Form 8609 and the Form 8609-A instructions to allow taxpayers to claim the low-income housing tax credit without having received, received a 8609, and as long as the failure to receive the 8609 is due to reasonable cause and not willful neglect. The Affordable Housing Tax Credit Coalition also proposed that the IRS use the same approach as historic rehab credits in allowing credits for the historic rehab credits if certification hasn't yet been received from the agency that handles this. The National Park Service is the agency responsible for the historic rehab credits. So if a certification hasn't yet been received from the National Park Service, the credit, the rehab credit can still be claimed on return if proof is provided that the National Park Service has received the certification application. And the Affordable Housing Tax Credit Coalition have not yet received a formal response from the Internal Revenue Service regarding these proposals. Currently, the statute under the Internal Revenue Code allows the credit without a certification by the taxpayer. If the failure to make the certification, you make the certification on the Form 8609, if the failure to make the certification is due to reasonable cause and not willful neglect. So it's stated in the law that it's allowable to take the credit even without having the 8609. However, the current form 8609-A is not designed to accommodate the claiming of credits when the Form 8609 hasn't yet been issued by the state credit agency. There's a question on the form that says, do you have in your records the original Form 8609 signed and issued by the Housing Credit Agency? And if the response is no, the form instruction says the taxpayer should stop, when you're completing the 8609. If the response is no, the form instructs the taxpayers to stop and do not go on to part 2 of the form, which is where the credit is calculated. So in the event that the IRS will not change their Form 8609 requirements to provide the administrative relief, I think we, taxpayers and the accountants, we should consider filing the return and claiming the credit on the tax return, even though the 8609 hasn't been issued by TCAC, if there is reasonable cause, and the taxpayer will need to provide a reasonable cause statement that is sustainable and based on the facts and the circumstances. And the investor limited partner in that partnership will need to agree to the reporting of credits prior to the issuance of 8609. The reasonable cause statement will be attached to the return if we were to go with this approach. So we would attach a statement, a reasonable cause statement, along with the usual information that one would see on the Form 8609 and the 8609A. So basically, in lieu of filing the Form 8609A, we would attach a computation of the credit amount, the taxable year in which the building was placed in service. We provide them information with regards to the qualified basis of the building and the qualified basis as of the close of the first year of the credit. We'll provide them with the applicable percentage and also the set-aside election. Okay, so that's all I have with regards to the CARES Act tax implications for affordable housing business. Okay, do we have any questions?
I've unmuted everyone, so if you have questions, go ahead and speak up. You have to unmute yourself first. Seems like the big takeaway. Go ahead.
Oh, I was just going to ask Dan, is anyone working with TCAC and seeing if they're able to issue the 8609s faster?
Well, I don't know if anybody is working with TCAC to do so, but I saw something just recently, and I think it was coming from TCAC saying that they are overloaded with work, and they were saying that instead of taking the usual 2 months to process these place in service packages, it's taken them twice as long, four months.
I disagree with that. Our last one we just received, it took a year.
Took a year, okay.
So presumably the reasonable cause write-up that you would attach to the return would explain that in California, this processing is taking 6 months to a year, and it was submitted on such and such a date, and the return is due on this date, and the reasonable cause for not having the 8609s in time is that California is just very slow in processing those forms.
Right, that would be a good reasonable cause because it's already out of your control.
Yeah, maybe in some other state it's faster.
But I would wonder if they're just due to just timing, when it's placed in service, when the tax return's due. I mean, it could be a short lead time anyway, that no reasonable time, there wouldn't be a reasonable time frame for TCAC to be able to issue the 8609. And even in those cases, would we just take the same approach, you think?
Well, I guess if you're placing it in service in 2019 by December 31st to claim the credits, and the return is due by September 15th of 2020, so that's 8.5 months later, you would think that would be long enough.
That's worst case scenario. Okay.
Yeah.
Right.
Other questions?
So,
yeah, that issue, we thought it would be good to present this issue today because a lot of the clients have been complaining since the enactment of this new delay in claiming credits that means that you can't even go back and amend your return to claim credits for those prior years anymore. You have to wait and start claiming the credits in the year that you actually get the 8609s, which could be several years after, or could be a year or two after placed in service. So that seemed to be a hardship, and it was resulting in a lot of downward adjusters. So that's good news that there's a workaround with the reasonable cause that people can rely on, maybe. All right. Well, thank you, Stan. And thank you,
Okay,
Julie.
you're welcome.
Thank you, Julie, for helping with all of this. And does anyone have any other questions or comments on any of the things we talked about today? In the meantime, please send me another chat if you want CPE credit. This will be the final poll question. Do you want CPE credit or not? Send me a chat response if you do. And ask any questions. We have a few minutes left, about 5 minutes left. If you have any questions, or if you want to talk about anything off topic, that's fine too. This is a roundtable for all affordable housing developers to bring up issues.
I put something to the chat, and we got a PPP allocation under $2 million, so hopefully we won't be audited, but we don't know. We're trying to make the argument, and we don't know if it's going to pass muster, but all of us have reserves of some sort. Well, a lot of us have reserves for development or whatever, and kind of wondering if even despite that, can you still make the argument that there's an economic need for this PPP funds? We're still struggling with that. We're trying to document it the best we can, but it's troublesome.
Yeah, it's a little vague. I think that certainly you can make the argument that the coronavirus situation has created enough uncertainty that you needed the PPP funds. Even though you have reserves, obviously the point of those reserves was not to spend them down during coronavirus lockdown. So you don't want to touch the reserves if you can avoid it. That's for the long-term benefit of the properties. So I think that's a good argument to make. It's a little different, the reserve question, compared to the earlier issue, which was the double dipping issue. You're not actually using the reserves to fund payroll. Yes, true, they're there, and there's even third-party restrictions on how and when you can withdraw from those reserves, and maybe they would not allow you to use them for this type of payroll cost to begin with. Somebody else
This
had
is
an
at the
interesting.
developer level.
Somebody else had an interesting item in the chat question that came up while Stan was talking, and I answered it in the chat. But just to let everyone know, this person in Vermont had received advice from their lender that because they were in a passive activity, which is the rental activity for their affordable housing properties, the passive activities were excluded from participating in PPP loans because they were passive businesses. And so this is Ann Duffy from NPO in Vermont said that they had argued that because they're a 501c3 and the PPP is supposed to extend to all 501c3s, there shouldn't be any passive business limitation on that. But apparently the lender was holding firm with that they were not eligible. So I wondered if anyone else ran into that roadblock where, because they're in the rental business, their lender told them they couldn't even get a PPP loan in the first place. I hadn't heard of anyone else encountering that issue. So that might be a lender-specific interpretation. No one else encountered that? Yeah. So if that's true, then maybe try a different lender.
Scott,
Yeah.
this is Ann Duffy. Can you hear me?
I can.
Yeah, I just wanted to say that, so that started with a lender, and then we actually took it to the SBA, to the district, to a district official who, yeah, they would not disagree with the lender. I mean, we've taken it to our congressional delegates to help work on this as well. But the SBA would not honor the position that these organizations are nonprofits, and therefore the SBA did not want to take a position on it. But it's still pretty murky, and some folks are pretty nervous about it.
Interesting.
So the lender started it, but the SBA didn't squash it.
Yeah, it's interesting. So they were making an argument that even though you're actively developing and managing affordable housing properties, maybe even providing resident services and things like that, they are equating what you're doing to like a passive landlord who's just collecting rents and doesn't have really any employees involved in the rental activity.
Exactly. Yes, and we've made the argument that we're a funder. We're not a housing provider ourselves, but on behalf of a number of housing organizations in Vermont, we made the argument that these folks are providing other services, and yeah, they're not a typical passive landlord. So we'll see. There's still a lot going on about that, but I'm just curious if other people in the country have heard anything like this. So
doesn't sound like it. Nobody spoke up when we asked if anyone else encountered that. So that is kind of a
that's
scary.
good. Yeah, thank you.
You're welcome. Okay, well, we are on the hour now, so it is time to adjourn. We'll try and have our next quarterly meeting in a few months, and in the meantime, you'll probably get an email. Certainly, if you're asking for CPE credit, you'll get an email, and I think everyone will probably get an email anyway, asking for evaluations. But to get CPE, you do have to complete the evaluation. Otherwise, it's optional. So thank you all. Thank you again, Julie and Stan, for participating. And good luck with things. Hope everyone can stay safe. Bye-bye.